An oligopoly is an economic market structure where buyers only have 3 to 5 companies that they can buy particular products and services from. There is not many options like perfect competition or monopolistic competition for the products and services that they're looking for. Buyers in this situation are going to be price takers since there's only a select amount of companies offering these products and services in an oligopoly. Buyers do not control the market. For example, if a buyer wants a soft drink, more than likely it's going to be a Coca-Cola or Pepsi product. If you have a cell phone, more than likely it's going to be a Verizon, AT&T, or T-Mobile service that you're signed up for. That's another example of an oligopoly. From a seller's perspective, there's only a couple competitors that you're competing with. And these companies use the market to establish their price. You're going to look at the 3 to 5 companies that you're competing with and look at their price. And that is really going to be where the market is going to be set. There is some interdependence between companies. Now, this interdependence can result in collusion. Since there are only a couple players in the market, there is a lot of temptation to collude, meaning company A reaches out to company B, simultaneously raise prices. There is a fine line between competing and collusion within an oligopoly. Let's talk barriers to entry because this is going to be very different from the other 2 categories that we've talked about so far. New companies will have a challenging time establishing themselves in a market that is an oligopoly. Legal costs, patents, startup capital, supplies, raw materials. This can be overwhelming hurdles for a company trying to establish themselves when you have 3 to 5 competitors in that marketplace. In addition, companies will strategize against newcomers to the market. They can undercut competition with price wars, or they can just make you an offer you can't refuse through M&A, mergers and acquisitions. Another barrier to entry and a strategic advantage an oligopoly, a company within an oligopoly will have is the ability to develop operational efficiencies. These economies of scale can give them such a strategic advantage and make it almost impossible for a new company to establish themselves within that marketplace. If you have economies of scale, you can double production, and that doubling of production doesn't necessarily mean you're doubling your cost of that production. There's plenty incentive to innovate within an oligopoly. You're still competing with 1, 2, 3 other major players within your industry. Innovating or innovations can give you a strategic advantage over those other competitors. Now, in addition, a large company within an oligopoly should have the financial backing to invest in research and development, which is another advantage for a large company that has cash flow or excess cash.